An internal control is a process or procedure put in place to protect assets, promote effective operations, and ensure accurate accounting and record keeping. An effective system may prevent and detect errors and irregularities. Keep in mind that the extent and type of internal controls depend on the nature and size of the business. While the gold standard for risk management and internal control systems design is the Sarbanes-Oxley legislation and the COSO framework, not all businesses will abide by the gold standard. An internal control procedure could be as simple as having a procedures manual for training purposes, or requiring a username and password to sign into a system, or performing monthly bank reconciliations. An internal control is simply a checkpoint to ensure that a process is working correctly. Properly designed control activities increase management's confidence that assets are being safeguarded and that the accounting data processed by the accounting system can be relied on for sound decision making. On the other hand, lacking or defective internal controls lead to inaccurate financial reporting, unintentional or intentional employee errors, and even theft or fraud. There is a weakness in an internal control system if an internal control does not work as intended to protect assets and ensure reliable accounting. There are two common examples of internal control weaknesses. Example 1. A company has a written policy that provides that credit decisions are made by employees other than salespersons. However, the company portal for approving credit uses the same username and password as the portal salespeople use to monitor inventory. In this case, salespeople would have the ability to log onto the credit portal and approve credit to customers to facilitate their own sales. The impact is that credit could be extended to customers with a bad credit history. This is a weakness in internal control which could be cured by separating login credentials so that salespeople cannot have access to the company credit system. Example 2. A company keeps valuable inventory in a special safe that requires 2 employee IDs to be accessed. This may be a smart internal control to prevent theft, but suppose that a supervisor routinely gives his or her ID to employees to take items from that special safe. In this case, the weakness is in the enforcement of the internal control. The consequence is the failure of the internal control altogether. In other words, valuable goods could be stolen and the supervisor would not know. There are 6 key control procedures. Procedure number 1, establish a document trail. In this procedure, we focus on preparing proper documents to support business activities that have occurred. Some examples include the use of pre-number purchase orders for purchases, or the use of pre-numbered invoices to bill customers and account for missing invoices. Procedure number 2, establish responsibilities. In this procedure, we assign responsibility to persons accountable for functions within an organization. For example, a bank teller or cashier is responsible for reconciling his or her assigned cash tray and ensuring that there is no cash or fund shortage at the end of a shift. The manager is then responsible for authorizing expenditures within his or her own operating department or cost center. Procedure number 3, segregate or separate duties. Segregation of duties is fundamental to ensure that authority and control are not centralized in one person. For example, personnel handling cash should not also be in charge of accounting. Credit limits should be authorized by the credit manager, not by the sales personnel. Procedure number 4, physically protect assets. In this procedure, we focus on restricting the access to assets or information to those who need it, thereby limiting unnecessary, unrestricted access to everyone else. This may include using a safe to store valuables such as cash or jewelry, or restricting access to systems and information using passwords and firewalls. Procedure number 5, establish policies and procedures. In this step, we focus on setting up policies that apply to everyone consistently. This may include writing employee manuals, requiring certain trainings, or making it mandatory for employees to take vacation time. Procedure number 6, review operating performance. The final step involves a review or check on the previous steps. Are the internal controls working as intended? And if they're not, who should investigate and make changes? These reviews are conducted by an internal audit team which reports to the company's audit committee. The audit committee is a subcommittee of the board of directors that is in charge of overseeing financial reporting and disclosure. The audit team periodically reviews the efficiency and effectiveness of operations and controls and recommends corrective action. Internal controls come with inherent limitations. An inherent limitation is the concept that in every well-designed internal control system, there will be an unavoidable element of risk and weakness. One of the inherent limitations is employee cooperation. If employees do not understand how the control works, they may misjudge the importance of a control and bypass it. This typically happens when the employee feels rushed to meet a deadline. For example, in order to meet the cutoff for payroll, employee pay rates and hours may not go through the appropriate review and scrutiny prior to issuing paychecks, which in turn could result in incorrect paychecks. It is important to note that an overkill of control procedures could be just as bad as insufficient control procedures. If controls are too stringent and make the day-to-day operations too cumbersome, employees may ignore them or try to bypass the control. This is why, before internal controls are implemented, they are subjected to a cost-benefit analysis. A cost-benefit analysis evaluates whether the benefits of the internal control will outweigh the burden that the internal control will pose on the organization. Imagine a very tight system of control on inventory. Before every good is shipped, 12 approvals are required. This could be extremely effective in ensuring inventory is not stolen, but it also severely slows down the shipping process. It also demands a lot of paperwork and employee time just seeking approvals. In turn, the company loses efficiency and is no longer competitive. Clearly, the cost of the internal control does not outweigh the benefit.